Welcome, dear traders. This is the recap of the Asian session on May 12 with me, Kate Stichina. Today, Japanese markets hit the highest level in almost 18 months. In the meantime, stocks in Australia, New Zealand and China have had several straight days of losses due to declining commodity prices and the situation in the US market. The latest US inflation and labor market data suggests that the world's largest economy is slowing down. This may allow the Federal Reserve to pause its interest rate hikes next month. According to the CME FEDWATCH tool, market participants are pricing in an 88% probability of interest rates being unchanged. However, the number of people expecting a rate hike has increased to about 12%. Amid risk related to the banking sector and the US debt ceiling deadlock, such forecasts may look premature. However, they reflect the general mood of investors at the moment and help us understand how optimistic the markets are. This might seem strange, but US economic woes may actually give strong support to the US dollar, which still remains the global reserve currency and the safe haven asset. The global economic slowdown is driving the dollar higher, while speculation over the possible Fed rate hike pose is pushing the currency down. The US dollar index did rise yesterday under the influence of these two opposing forces, but only slightly. Over the past 24 hours, the US dollar experienced a strong volatility against the basket of currencies, fluctuating in a narrow range between 101.90 and 102.10 points. As a result, the greenback increased to 102 points during the Asian trading session, set to post its first weekly gain in 3 years. A new round of negotiations on the US debt ceiling is scheduled for Friday. Although the President and Congress have not yet reached an agreement, few people believe that a true default is imminent. A US debt default would lead to the collapse of the US economy, and no branch of the US government really wants such an outcome. Ultimately, they can simply increase the money supply to cover the budget deficit, which means printing more dollars. While the safe haven dollar is under the influence of conflicting factors, US government bonds and the Japanese and Swiss currencies are increasingly becoming more appealing. As a result, the yen rallied to 133.80 following the cooler inflation print in the US yesterday. However, the Japanese currency retreated afterwards, and the dollar-yen pair returned to a higher range. Early on Friday, this range shifted slightly upward, and the pair traded between 134.40 and 134.90 today. Just like the US dollar, the yen has been affected by conflicting factors. The Bank of Japan's persistently dovish stance deters bulls from betting aggressively on the yen's upside movement. At the same time, the yen has found some support from a fallen US Treasury bond yields and uncertainty about US sovereign debt. However, this support is still not enough for the yen to fully withstand the pressure from the US dollar. As a result, the dollar-yen pair gained some ground during the Asian session and reached 134.80 yen per dollar. Against the background of a contradictory market sentiment, the Aussie-US dollar dropped to a new weekly low at 0.6682 in the Asian session. After that, it rose to 0.6690. The Aussie is also weighed down by the waning risk appetite in the US stock market and falling oil prices. During the Asian session, the Australian currency traded mostly lower. Waiting for news, the pair has been consolidating in a range of 0.6683 and 0.6710. Notably, the Reserve Bank of Australia's potentially hawkish outlook and the start of a trade talks with China also did not help the Aussie. The first face-to-face meeting between the trade ministers of the two countries since 2019 is scheduled for this Friday, according to media reports. In these talks, Australia wants to secure a deal to lift China's multi-billion-dollar sanctions imposed on Australia agricultural exports. However, the debate between the US President and Congress over the national debt ceiling is far more important for the Australian currency today. The New Zealand currency fell against the US dollar in the Asian session due to negative sentiment in the markets, and the Kiwi dollar pair broke the ascending trend line formed at the end of April near 0.6300. It now appears that the pair is about to post a weekly decline after the previous two sessions of gains. The Kiwi continued to give bearish signals as it traded lower within a range of 0.6237 and 0.6309 early Friday morning. Meanwhile, there are growing concerns in the domestic market that the country's economy is already in recession. It's likely to remain in this state next year. According to today's report, the business activity index fell to 49.1% in April, and the Reserve Bank of New Zealand will have to fight against stubborn inflation, which hit a whopping 7.2% in the first quarter. And that's all for now. Subscribe to our channel and keep close tabs on the latest market news. And see you soon.